Assalamu alaikum listeners, welcome back to the discussion of financial accounting. Today I'm here to discuss the exercises of chapter number 11 for financial accounting. The topic is current liabilities. I have already uploaded the recordings regarding the discussion of topics which are covered in it. Like we talked about notes payable, we talked about current maturities of long-term debts. Then we also talked about some other sort of current liabilities. So, if you have not heard the recording of theoretical discussion of chapter number 11 along with some examples, then I will advise you that first go through the chapter, listen to that recording. There is one recording regarding chapter number 11, and then come back to this recording for the discussion of exercises. I have chosen some exercises to discuss with you, so here are they. Let's start from our first exercise, that is exercise number 11-1. C.S. Lewis Company had the following transactions involving notes payable. So they are telling us that notes payable transactions are there. Notes payable could be long term and they could be short term. Short term are those who fits into the definition of current liabilities. Okay, the definition is operating cycle or 1 year, whichever is longer, right? This is how we define a liability as a current or long term. So let's read the discussion and then try to figure out that the liability is these notes payable are long term or short term. So July 1st, 2017, Lewis has borrowed $50,000 from First National Bank by signing a 9 months 8% note. Now, if you remember that when I discussed the theoretical content of this chapter, I told you that notes payable, their rate is usually annual. If it is not annual, it is specifically mentioned that it is semi-annual, monthly, or quarterly. Here, nothing is mentioned, so 8% is annual. 9 months is the life of this note, so it fits into the definition of current liabilities. Another important thing which I have told before, that the borrower, he is the one, or the borrowing party is the one who signs the note, okay, because they are promising that we will return. So Luis has signed this note. 9 months is the life, 8% is the interest on the note, and on July 1st, 2017, he has signed it. Let's move towards the second one. The second is on November 1st, 2017, borrows $60,000 from Lincoln County State Bank by signing a 3 months 6% note. Now it's 3 months, it's also fit into the definition of current liability, and 6% is the interest on this note, and this is another bank. This is not First National Bank, so this is another borrowing, another note. December 31st, 2017, they want us to record the adjusting entries. In this question, the adjusting entries are regarding the notes payable, and notes payable adjusting entries are always interest. Okay. Then February 1st, 2018, pays principals and interest to Leon County State Bank. They paid the principal on February 1st, 2018. Let's check why on February 1st, 2018. So the borrowing was on November 1st, 2017. The life of the note was 3 months, right? So if the life of the note was 3 months, so November, December, and January 2018, these are the months for which this money was borrowed. And of course, on February 1st, the money should be returned. So we will be paying back principal as well as interest. Then on April 1st, 2018, pays principal and interest to First National Bank. Now let's move towards the borrowing or made from the First National Bank. That was on July 1st, and the life was 9 months. So from July 1st, 2017 till March 31st, 2018, 9 months are over. So on April 1st, 2018, which is immediately next day, you are returning this loan. What we are supposed to do, we are supposed to prepare the journal entries for the transactions. So for all these transactions, we have to prepare the journal entries. I will just remove this because I need to discuss them again. So starting with our first entry, which is supposed to be done on July 1st, 2017. What happened on that day? The company has borrowed from First National Bank. How much money they have borrowed? 50,000. So when they borrowed the money, they get cash. So on July 1st, 2017, the cash gets debit and they signed a note that they will be paying the money back. So note payable gets credit with the money borrowed. The borrowed money is 50,000. Okay. Moving on towards the second November 1st, 2017, what happened? They borrowed again $60,000 from Leon County State Bank. So let's do this. November 1st, 2017, they again get cash 60,000 and note payable 60,000 gets credit. Let's move on towards the adjusting entries regarding these two borrowings. So, firstly, let's do for First National Bank. How much money was borrowed? You have borrowed $50,000. What is the rate of interest? That is 8%. Okay, then we need to count on the partial year factor, right? We borrowed on July 1st and 31st December, 6 months, right? July, August, September, October, November, and December. So 6 months. 6 months interest is due, right? So we will be recording at 8%, 50,000, 6 months interest on December 31st, 2017 for First National Bank. For Leon County State Bank, what we will be doing, money was borrowed on November 1st. So till December 31st, November and December, 2 months are over. So 6% rate I will use. 60,000 is the borrowed amount and 2 months interest. So 2 by 12. Okay, that will help me in calculating the interest. I also mentioned another point that most of the time for short-term notes payable, the interest is paid along with the return time of principal amount. It means that when you return your money, borrowed money back at that time, you pay all the interest, usually for short-term notes. But again, it depends on the discretion of the bank. If they want it quarterly or semi-annually, they can add those terms. In this question, nothing is mentioned, so we will take the basic terminology that this company accrue all the interest payable and interest, and then it paid it along with the principal. Okay, because here you can see it's clearly mentioned. So let's record this journal entry on December 31st, 2017. For First National Bank, 50,000 was borrowed, 8% is the rate, and for 6 months we have to calculate the interest. When you simplify this expression, interest expense comes up 2,000, and we are accruing this interest, means we are adding it to our liability, so interest payable gets credit 2,000. For the second bank, Leon Bank, interest expense 60,000 is the borrowed money, 6% is the rate, only for 2 months we need, so 2 by 12, that comes up 600, and interest payable gets credit. Okay, let's move on towards the next required entry, that is on February 1st, when they pay back the principal as well as interest to Leon County State Bank. Here, let me discuss some factors with you. If you remember, for Leon County State Bank, we have only recorded the interest of 2 months on December 31st, right? Interest of January is not recorded because it was not the requirement. But we cannot ignore it because you have to pay for the January month as well. So here at the time of payment, we will not only pay the principal and the accrued interest, we will also calculate the interest for the month of January, which is not calculated yet, and then we will pay that interest expense as well on the same day. Okay, so let's do this transaction. Firstly, how much money was borrowed? 60,000 money was borrowed, and interest payable we have recorded this one, 600. So notes payable will be returned, interest payable will be returned, but don't forget to pay 1 month, January month interest, because it was not recorded. So let's record interest expense for the month of January. How you're going to do that? The same way, 60,000 money is borrowed, multiplied by 6%, multiplied by 1, because only for the month of January, 1 by 12. So it will give me an answer of $300. Okay, so interest expense gets debited $300, and altogether I am going to pay these things in form of cash. So cash gets credit 60,900. Let's move on towards the last journal entry, which is on April 1st, 2018. They pay back the principal and interest to First National Bank. Similar to the previous bank, Leon County State Bank, where we have recorded the unrecorded interest of January, we also need to do the same thing for First National Bank as well. On December 31st, we have recorded the interest for the 6 months. Remember, from July till December, 6 months interest you have recorded. Check over here. This is the one, 2000, right? But from January till the return date, which is April 1st, so January, February, March, and April, these months' interest is not recorded yet, right? So January, February, March, and April, no need for April because it's April 1st, no need for April month. So 3 months interest further I have to record. Let's do this calculation. How much money was borrowed from First National Bank? 50,000. What was the rate of interest for First National Bank? That was 8%, right? 8%. And for 3 months, I need to record the interest. So when I do this calculation, that comes up $1,000. Okay, so now I will be returning the money notes payable, which was liability 50,000. It gets debited. The accrued interest which we have recorded in December 31st, that will also be paid. So interest expense gets debited, interest payable gets debited 2000, and just now we have calculated 3 months interest expense. So let's record this unrecorded interest expense 1000, and all together we will be paying on April 1st. So cash gets credit 53,000. So this is how we solved question number 11-1, which showed us different facts and figures regarding the notes payable. Let's move on towards the next exercise, which is 11-2. Let's check it out. On June 1st, Berando Company borrows $90,000 from First Bank on a 6 months, so life is 6 months, $90,000, 8% note. So they borrowed this money, and the note amount was also this same. The rate of interest is 8%. Because you are in early concepts of financial accounting, that's why I would introduce you with something that sometimes the borrowed money is not the same with the note amount. They could be different, and you are going to see this in some advanced chapters of financial accounting. But for this example, for this exercise, whatever money was borrowed, the same amount note was signed by this company. Okay. What are the instructions? Firstly, because on June 1st the borrowing happened, so they want us to record the journal entry on June 1st. Then they also want us to record the journal entry on June 30th. Okay, and then point number C is prepare the entry at maturity, which is December 1st, assuming monthly adjusting entries have been made through November 30. Means till November 30th, all the monthly adjusting entries. What are monthly adjusting entries? Interest recording. That's already being done. I added this point for you because if the monthly adjusting entries are not done, then what you are going to do? Okay, so this is a variation. You will not find this with the regular question, but it's important to know this point as well. So point D, which is added by me, that is prepare the entry at maturity December 1st, assuming monthly entries have not been made after June 30th. June 30th we recorded. Now after that they say you did not record any other adjusting entry. and then what was the total financing cost. For the borrowings, financing cost is the interest you pay. Okay, so for notes payable, because the extra money you pay, that is interest, so that is the financing cost for you. So whatever interest calculation or altogether we will do for this question, they all will be considered as financing cost. Let's start from first journal entry, June 1st, the borrowing happened 90,000. So cash gets debited, notes payable gets credit 90,000 and 90,000. Second journal entry, prepare the adjusting entry on June 30th. So if you want to prepare the adjusting entry, count on how many months are gone from June 1st till June 30th. Of course, 1 month only. The rate of interest is 8%. So here I did the calculation. Borrowed money is 90,000. 8% is the rate of interest, and I only need the interest of 1 month. Okay, so when I multiply this, interest expense comes up 600, and accrued interest, which is interest payable, that is also 600. On December 1st, when we are, point number C says that prepare the entry at maturity December 1st, assuming monthly adjusting entries have been made through November 30th, means till November 30th, the monthly entries are being made. What are the monthly entries? As I mentioned before, the interest entries. So it means that June entry we did it, July entry we are assuming it's done, August entry it's done, September entry it's done, October entry it's done, and November entry it's also done. So all the 6 months entries, they are already made, so we don't need to make any adjusting entry for the interest. But we need to know that what is the interest payable, because at maturity we have to pay back principal as well as interest payable, right? So if you see over here, there are two ways to calculate the interest. If you see June, in point number B, we calculated the interest of June as 600, right? Remaining 5 months we need to know. So what is the formula? If you go through the formula, that is 90,000 multiplied by rate of interest multiplied by 5 more months divided by 12. I need it because I need to know the 6 months interest. Okay. Another way is 600 is the monthly interest I need for 5 more months. So 600 multiplied by 5, that is also 3,000. Okay, so both ways are okay. If you see here, I did it with the formula. You can also simply multiply and calculate your interest payable. Okay, so altogether, how much interest payable is there in first journal entry? Over here in point number B, we calculated the interest, and then this one, we calculated the interest payable, and then 5 more months interest is already recorded, so we don't need to worry about that. So that is 3,600. You can also do it directly, no need for monthly calculation and all those. I have to tell you because I need to show you the multiplication method as well. You can straightforward also calculate it. Full interest for 6 months, 3,600. You want to opt. Okay, so on December 1st we are paying back notes payable, also interest payable, and then cash will get credit. 90,000 notes payable are returned, 3,600 interest payable also paid back, so altogether 93,600 cash is paid. Let's see the variation which we added for you, that in point number B we have done the sorry, in point number B, we did the recording of the June 30th, but after that, for July, August, September, October, and November, in point D, we are saying monthly entries have not been made. So there is no interest payable which is recorded. So what we will do, like previous question, we will record interest expense and pay it simultaneously. Okay, but 1 month interest is already recorded with the help of journal entry number B. Okay, so let's check it out. It's over here. Notes payable. this one. Notes payable gets debit because I'm returning it 900. Interest payable, which was recorded in journal entry number B, that is also being paid back. And interest expense of remaining 5 months. I told you how to calculate it if you see over here. This point. Sorry, not this one, this one. 3000 because I need for 5 months, we can use it. So if you see, it's being done over here. I recorded interest expense 3000, which is for 5 months, which was not recorded. I'm not debiting interest payable because it was not recorded. I have to debit interest expense. I have to record the expense. So altogether, we are paying this amount 93,600. And what is total financing cost? I already told you the interest expense is the total financing cost. So 3,600 is the total interest expense for us. Let's move on towards our next question, which is 11-3. This question is about, let's read it and try to identify which type of current liability is this. In performing accounting services for small businesses, you encounter the following situations pertaining to cash sales. Number one, pool company enters sales and sales taxes separately on its cash register. For the sales taxes, if you remember, I told you that sales taxes are collected from the customer, but they are returned to the government because they belongs to the country, right? So whoever is the revenue department of the state, you return the taxes to them. So they are liability for you. So this company, which is pool company, they enter the revenue as and the sales taxes separately in their register. So on April 10, the register total are sales $30,000 and sales taxes 1,500. So what we are supposed to do, we are supposed to record the journal entry for this. Second transaction, this is another company, Waterman Company, does not segregate the sales and sales taxes. So whatever amount we find out in the cash register, that includes the revenue plus the tax figure as well. Its registered total for April 15 is 25,680, which includes 7% sales tax. So this amount includes revenue of 100% and sales tax of 7%. Okay, remember this point. Let's record the journal entry because they say record the entry for the sales transaction related to related taxes for each one. Starting with pool company. Okay, let's record for them. It's over here, April 10. The cash register shows the sales revenue of 30,000. If you see in transaction number, this one, 30,000, and sales tax is 1,500. So sales revenue gets credit. Revenue is always credited whenever it increases. Sales taxes payable 1,500. It was separate, so we know that how much is the amount of sales taxes payable, and 31,500 was the total of cash in the cash register. For Waterman Company, 25,680 was the total for the cash register. Okay, so cash gets debit 25,680, but it includes 100% of sales revenue and 7% of sales tax, this cash amount, right? So let's segregate. How we will be segregating? 25,680 is the total, 100% is the revenue in it, and 7% is the sales tax in it. So it has a total percentage of 107. Or you can also say 1.07, right? So if I divide this amount, 25,680 with 1.07, I get my revenue, sales revenue. Okay, and when I divide it, the amount comes up 24,000. If out of 25,680, 24,000 is my revenue, what is remaining? Remaining is sales tax. So 1,680 is the sales tax payable. So sales revenue gets credit 24,000, sales tax payable credit 1,680. So this is how you segregate the sales taxes if they are added together in the sales revenue or the full cash amount. You have to divide the total percentage, and in this way you will be extracting your revenue. Let's move on towards the next exercise, which is exercise number 11-4. Morino Company publishes a monthly sports magazine, Fishing Preview. This is the name of the magazine. Subscription to the magazine costs $20 per year. So if somebody wants to subscribe this magazine, means if they want to receive magazine every month, they have to pay $20 for the full year. One time $20 for 1 year. During November 2017, Morena sells 15,000 subscription, means 15,000 people has bought or 15,000 subscriptions were sold. Beginning with the December issue. So first magazine of the year will be sent to the people on December 1st. December. Second will be sent in January. Third will be sent in February and likewise. Morino prepares financial statements quarterly. Quarterly means March. Quarter has four parts, right? So March, then June, then September, and then December. So these are the months when you prepare. Okay, prepare the entry. So where were we? Okay, and recognize subscription revenue at the end of the quarter. When you receive the subscription in advance, because no magazine is being sent to the customer, so this collected money is a liability for you. So you cannot credit subscription revenue. You have to credit unearned subscription revenue, right? They say at the end of every quarter, this company records the subscription revenue. What does it mean? The liability, which is unearned subscription revenue, that will reduce and the revenue will be recorded. You don't do it monthly. Like let's suppose when on December you sent first magazine, if it is not the part of the quarter, you are not going to close it. But let me just give you another month because December is the closing of quarter. Let's suppose first magazine is sent on January. It's an example, okay? So on this January, you will not record your revenue. You will wait for March, and then in March, you are going to record your revenue. Means your subscription revenue will debit and your revenue will credit. Not on monthly basis, on quarterly basis you do that. If you see here, the first magazine is sent on December, and December is the end of quarter. So that's why at the end of December we have to record our revenue. But they have given us clear instructions, so we will be following the instructions. Okay. The company uses the accounts on subscription revenue. This is a current liability and subscription revenue. So when the revenue is earned, you use this revenue account, which is subscription revenue. Instructions are number 1, prepare the entry in November for the receipt of subscription. So you have collected the money in November for full year. How much money? $20 for each subscription. So 15,000 subscriptions are sold. So cash gets debit on November, 300,000, and unearned subscription revenue gets credit with 300,000. Okay, because of the calculation it moved down, so you can also do it in this way and calculation as a footnote like star. It's up to you. Okay. Then point number B is prepare the adjusting entry at December 31st, 2017 to record the sales revenue recognized in December. By the end of December, because it's December 31st, only one month's earned revenue is revenue, because out of 12 magazine, only one magazine is sent to everyone, right? So out of 12 months, only 1 month earned revenue becomes a revenue. So total revenue which we have recorded, unearned revenue which we have recorded, that was 300,000 and it was for 12 months. Now we have to extract 1 month revenue out of it, so that is $25,000. Okay, so December 31st, unearned subscription revenue gets debit because my liability for 1 month is no more a liability. We have earned that revenue. So unearned subscription revenue, which is current liability, it decreases. So we debit it and we recorded our revenue for the first month. Then point number C says that prepare the adjusting entry at March 31st, 2018. So March, I told you it's second quarter of the year, right? Okay. December is gone. We already recorded the revenue of December. Now on March 31st, we have to record the revenue of January, February, and March. 3 more months, right? There are two ways to do that. The first way is multiply monthly revenue with 3. You will get your answer 75,000. And another way is the same way. Total revenue, unearned revenue was 300,000. Out of these 3 more months are now earned. They are our revenue. So 3 by 12, that is 75,000. So March 31st, unearned subscription revenue, which was my liability, current liability, it is decreasing because 3 more months are no more unearned. They are earned now. We have delivered the product to the customer, and subscription revenue gets credited 75,000. That's why I'm saying you again and again that please listen to the recording of discussion of chapter so that you understand the logic of unearned revenues. And then after that, when you listen to this recording, the question solution will be easy for you. But if you only try to learn from these exercises, then I'm worried that the concepts will not be clear to you. So please refer back to the recording of chapter discussion and then come back to these exercise discussions. Let's move on to exercise number 11-5. Bittencourt Company sells automatic can openers under 75 days warranty. What does 75 days means? 1 month has 30 days, right? So 30 is 1 month on average, 30 is second month, and 15 more, right? So it means 2.5 months, right? Anyways, let's move on for defective merchandise. So what is the product they are selling? At automatic can openers. 75 days is the warranty. Based on past experience, Bittencourt estimates that 3% of units sold will become defective during the warranty period. So estimated warranty, or you can say the current liability for the warranty, is 3% of the units sold. Management estimates that the average cost of replacing or repairing a defective unit is $15. So this is again from historical expectations, from historical data of the company, that when the cans openers comes for the repair, usually $15 company has to spend in order to repair them. The unit sold and the unit defective that occurred during the last 2 months of 2017 are followed. Months are two months last, so November and December. In November, 30,000 units were sold and 600 units come back. They were defective. And then in December, 32,000 units were sold and 400 units came back. If you remember, for November, still, we can expect that more units will come back. Why? Because from November till December, only 2 months are over, 15 days are still there. So maybe in January, we can expect more units. And for December units sold, we have December month, January month, and February 15 days we expect. So like this, the calculations happen. But these are the units sold and they are actually returned. But if you remember, we do not create the warranty liability with the actual facts and figures. We create the warranty liability with our estimates. So estimates are 3% units will be defective. Okay, let's move on. Prepare the journal entry to record the estimated liability for the warranty. So don't forget, it's from the expectation 3% of units sold. They are our estimated warranty liability. And the cost incurred in honoring 1,000 warranty claims. Can you see here how many units actually came back? How many warranty claims actually came back? They were 1,000. 600 plus 400 is 1,000. So they say that record the journal entry for honoring these claims. We said that in order to repair one unit, we incur $15, right? So for 1,000 units, we will incur 15,000. Second one is point number B, determine, they're not asking us record. They want us determine the estimated warranty liability at December 31st for the units sold in November and December. They say at the end of the year, now check how much more you expect that the units will come back. So we'll make a table and try to identify it. And point number C says that give the entry to record the honoring of 500 warranty contracts in January at an average cost of 15. So in January, some more units came back for the repair, and they said that average cost is still 15. Even if they don't mention 15, we know that it is 15. Okay. So let's move towards the recording of journal entries and some minor calculations along with these recordings. So firstly, warranty liability, we have to estimate 3% of units sold. How many units you sold? 30,000 in November and 32,000 in December, altogether 62,000. 3% of 62,000 is our, these are units, okay? If you multiply it with 3%, you will know that how many units you expect that they will come back, and 15 is the repair cost for them. Here, 62,000 multiplied by 3% is 1,860 units. We don't record the journal entry with units, we record it in dollar terms. So what is the dollar cost of these 1,860 units? That is 15, right? 27,900 is our expected warranty liability. So 27,900 warranty liability gets credit, and this is warranty expense. Then this also mentioned that 1,000 units cost we also need to record. So these are 1,000 units which came for the warranty. So now because 1,000 units out of 1,860, we are honoring them, we are repairing them. So they are no more going to stay in our warranty liability. So we have to remove them from our warranty liability, right? So 1,000 units we are repairing, 15 is the cost. So 15,000 liability will be reduced. Now the warranty liability status will reduce from 27,900. How much reduce? 15,000. So warranty liability gets debit 15,000. And it's because of repair parts. So repair parts gets credit. Point number B wants us to tell that how much remaining estimated warranty liability we expect. See here, 1,000 units we already honored till December 31st out of 1,860. So still 860 units we expect that they will come back, and their cost is 15 each. Let's make it in a tabular form. So this is the table I made. The months are here. Sorry, these are the months. November and December. What is estimated a warranty liability or units for them? Before I did total because I have to record the journal entry, but we know that in November 30,000 units were sold, and we expected that 3% will come back, so total expectations were 900. In December, 32,000 units were sold. 3% was our expectation that they will come back, so it was 960. So altogether 1,860. How many units were defective? This is given in the data set above. 600 were returned in November and 400 came back in December. So total 1,000 units came back. Remaining out of 900, we still expect that 300 will come back. And out of 960, we still expect 560 will come back because 400 are already done. So outstanding, how did I calculate? Estimated minus units defective which already came back. Okay, so 860 units we still expect that they will come back. So what is the liability? Per unit liability is 15, so 12,900 is remaining warranty liability we expect. Point number C was that this is over here, that gives the entry to record honoring of 500 warranty contracts in January at an average cost of $50. So let's do the same. My liability will further decrease. How much warranty liability gets debit? 500 units came back. 15 is the cost, 7,500. And repair parts gets credit, 7,500. Let's move on towards Exercise number 11-7. Younger online company has the following liability accounts. After posting adjusting entries, so adjusting entries are already done. Now these are the updated balances of liabilities accounts. They did not tell us current liabilities or long-term liabilities. We know that some liabilities by name that they are of current nature, and some we check their life with the operating cycle and we decide, right? See here, accounts payable. Accounts payable are always current because nobody gives you goods on credit basis for more than some months. Nobody will say, okay, take these goods for 2 years credit basis. No, it's always monthly basis, right? You have to return the money for the material you purchased. So 73,000 accounts payable are current. On ticket revenue is 24,000. Now it depends that on revenue is sometimes current, sometimes non-current, because if you have collected the revenue for more than a year, then in that case that's non-current. So we need to further identify that this on ticket revenue is current or non-current. If nothing will be mentioned, we will assume that this is current because this chapter is about current liabilities. Warranty liability is $18,000. Again, it depends that warranties are, if they are more than, if they are, let's suppose, 3 years warranty, then of course warranty liability would be non-current, because 3 years you expect that people will be returning their defective goods. But if it is less than a year or operating cycle, then in that case we say it's current. So we further need to see for warranty, we need to see for revenue, that are they current or non-current. Interest payable is usually current, 8,000. Mortgage payable. Mortgage payable is that borrowing which you have done by giving some property as a security to the lender. Let's suppose you borrowed the money. Let's suppose they borrowed this 120,000 from a bank. And to that bank, this company would have given a property document or something as security. So we call them as mortgage, because against them the security is the property of the company. Okay, might be they have given the papers of the building as security to this company. Okay, mortgage payable dollar 120,000. So it's is it current or is it non-current? We need to check, but usually mortgage payable are non-current because nobody can return that much big money in a year, right? It's usually in installments. Notes payable $80,000. Notes payable in this chapter we took them as current liabilities. Sales taxes payable. Sales taxes are of course current. You have to return them within a year to the government. Assume that the company's operating cycle is less than 1 year. So now they are telling us that the operating cycle is less than 1 year. So what was the definition of current liability? Operating cycle or 1 year, whichever is greater. So in this question, the life of the current liability should be 1 year because operating cycle is less than 1 year. So who is greater? 1 year is greater, right? Tickets revenue will be recognized within 1 year. So problem solved for the on ticket revenue. This is current, right? Warranty costs are expected to be incurred within 1 year. Again, warranty, we were not sure about it. Now we are sure. This is also current. And the note mature in 3 years. Note payable. I said in this chapter we took it as current liability, but now they clearly mentioned that it's for 3 years, right? So it means that it's non-current. Why? Because the definition says 1 year, but notes payable life is 3 years, so it's non-current, right? What we are supposed to do, prepare the current liability section of the balance sheet. Assuming $30,000 of mortgages is payable next year. Where is mortgage? This is mortgage is long-term loan, but out of 120,000, 30,000 is due in a year. So this 30,000 is current maturity of long-term debts. Remember this definition, this topic which we took in the chapter. So this 30,000 out of 120,000 will be mentioned in current liability section. So let's try to identify which amounts we will be taking as current liability out of all these liabilities, because we read the whole question now. So let's check. Firstly, accounts payable. Yes, we will take it. Earn ticket revenue. They said it's in 1 year, so we'll take it. Warranty liability. They said it's 1 year. We will take it. Interest payable. We will take it. Mortgage payable. Not 120,000. Only 30,000. We will take it. Notes payable. We will not take it because it's 3 years life. See here. Then sales tax is payable, we will take it, right? So let's make the section for the current liability. So here it is, younger online company. Don't forget to mention partial balance sheet because it's not full balance sheet. It's only current liability section. And then current liabilities, we are putting the heading and we are listing all the current liabilities with the amounts which we just took. If you see mortgages payable, I'm only mentioning up to 30,000, and then total current liabilities 163,000. For this mortgage payable, I remember when I was discussing this with my students, some of them they referred me towards the book and they said that, Miss, why mortgage payable, why not we write here current maturities of long term notes, so no long-term loans. So you can write current maturities of long-term loan as it is given in the book. You can write mortgage payable, specify it. It's up to you. If you write current maturities of long-term loan, then in notes to financial statement you have to mention that it's mortgage payable. Okay. So this is it about your chapter number 11. I hope that the terms are clear to you, the questions are clear to you. If there are some confusions, you can write them in the comment section of this recording. But again, I'll mention that please listen to the recording of the chapter first, then do these exercises, then the concepts will be clear to you. Use your pencils and copies while solving the question. Don't just listen and try to say that, yes, I know it. While writing, many things are different because you have to use the calculators as well. So hopefully it will be helpful for you. I'll again mention, please subscribe to the channel so that when I upload the next video, you know that it's there. Otherwise, you will not get any notification and you have to check the channel again and again that is there a new video or not. So take care everyone. I'll see you with the next lesson soon. Bye.